Hi, I'm Andy Temte, and welcome to the Saturday Morning Muse. Start your weekend with musings that are designed to improve financial literacy around the world. Today is October the 18th, 2025. Last week, we discovered how ancient Romans and medieval Venetians pioneered equity ownership, this idea that multiple investors could own proportional shares of a business enterprise. Both systems worked, the Roman and Venetian systems, but they shared a critical limitation. Investors were locked in until the ventures they had invested in came to a conclusion. Your ownership stake couldn't easily be sold to somebody else. This lack of liquidity, which is defined as the ability to turn shares into cash quickly, meant that only the wealthy could participate in equity investments. Today, we're traveling to the Dutch Republic in the early 1600s to witness the innovation that solved this problem and created the world's first true stock market. So, picture Amsterdam in 1600. The city is exploding with commercial energy, and everyone is talking about the East Indies, which is modern-day Indonesia, where nutmeg, cloves, pepper, and other spices grow in abundance. These spices are worth their weight in silver back in Europe, where they're essential for preserving food and doing things like creating medicines. But there's a massive problem. Getting to the Spice Islands and back requires an enormous investment. A single voyage to Asia could take up to 2 years. Ships had to be built or purchased, crews hired and provisioned, cargo acquired, and armed escorts arranged to protect against pirates and rival European powers. These capital requirements dwarfed anything that the Romans or medieval Venetians had faced. Dutch merchants tried adapting the old commenda model, forming temporary partnerships for individual voyages, but this created chaos. Each voyage required negotiating new partnerships, recruiting new investors, and waiting for ships to return before distributing profits and ultimately dissolving the company. Investors' capital remained locked up for years with no way to exit early. But in 1602, the Dutch government took a radical step. They merged competing trading companies into a single entity known as the VOC. The English translation of this very long Dutch phrase is the Dutch East India Company. Here's what made the VOC revolutionary. It was a permanent company. Unlike temporary partnerships that dissolved after each voyage, the VOC would exist indefinitely. It would own ships, warehouses, and trading posts as ongoing assets. It would send multiple expeditions out simultaneously, and most importantly, it would issue shares that investors could hold for as long as they wished. Initially, the VOC raised 6.5 million guilders. Thousands of Dutch citizens invested, from wealthy merchants putting in thousands of guilders to shopkeepers and craftsmen investing more modest amounts. Each investor received shares proportional to their investment with clear documentation of exactly how many shares they owned. But here's the crucial innovation that changed everything. These shares were transferable. If you needed your money back, you didn't have to wait years for ships to return and the company to dissolve. You could sell your shares to somebody else. The VOC would continue operating regardless of who owned its shares. Now, this transferability created something entirely new, a secondary market for shares. Now, the primary market is where companies issue new shares and receive equity capital. The secondary market is where existing shares trade between investors without the company receiving any additional funds. So, within months of the VOC's founding, shareholders began meeting regularly to buy and sell their shares. These trades initially happened wherever merchants gathered, on bridges, in taverns, and eventually in a specific courtyard in Amsterdam that became the de facto stock exchange. Prices fluctuated based on news from Asia. When ships returned laden with valuable cargo, share prices rose. When word arrived of ships lost to storms or captured by Portuguese rivals, prices fell. Investors learned that they could profit not just from the VOC's long-term success, but from correctly anticipating how news would affect share prices. This secondary market solved the liquidity problem that had plagued equity investment for over 1,000 years. An investor in 1605 who needed cash could sell their VOC shares within days or even hours. Their capital was no longer locked up in until some distant future date. This liquidity made shares dramatically more attractive, allowing the VOC to raise capital on better terms than any previous enterprise. The Amsterdam Exchange Bank, which was established in 1609, provided critical infrastructure for this secondary market. It offered secure deposit accounts and efficient transfer systems that made buying and selling shares easier and safer. The bank became the financial backbone supporting Amsterdam's emerging securities market. Now, the Dutch didn't invent the concept of fractional ownership from nothing. They had a few centuries of experience with partenrenderie, a system where multiple investors owned shares in individual ships. Under partenrenderie, a ship might be divided fractionally into 1632 or 64 shares. Different investors would own different numbers of shares, and profits from the ship's trading voyages would be divided proportionally. Some investors owned single shares in multiple ships, spreading their risk across many vessels rather than betting everything on one. So, this should sound familiar. This is the diversification principle that we explored in our insurance series. Just as Lloyd's underwriters spread maritime risks across multiple voyages, ship owners spread their investments across multiple vessels. The VOC essentially applied this fractional ship ownership model to an entire company. So instead of owning 1/32 of a single ship, you could own shares in a company that owned dozens of ships, along with warehouses, trading posts, and exclusive government-granted trading rights. So here's where equity ownership and insurance tackle the same maritime challenge using different tools. Both rely on the same fundamental insight about maritime trade, that individual voyages are unpredictable, but large numbers of voyages show reliable patterns. Insurance pools risks by having many people pay premiums to cover the few who suffer losses, whereas equity ownership pools investments across many ventures, allowing profits from successful voyages to offset losses from unsuccessful voyages. The VOC investor in the early 1600s knew that some ships would be lost, but they also knew the company would send dozens of expeditions annually. The predictable overall profits from successful voyages would overwhelm the losses from disasters as long as investors were patient and maintained their ownership through both good news and bad. Now, what does this mean for today? These innovations established the foundations for modern stock markets. Every time you buy stock in a company today, you're participating in a system that the Dutch invented over 400 years ago, and that system has 5 characteristics. Number 1, permanent companies with transferable shares. Number 2, secondary markets where shares trade freely among investors. Number 3, diversified companies spreading risks across multiple ventures. Number 4, liquidity that allows investors to exit positions without disrupting company operations. And finally, number 5, professional infrastructure supporting efficient trading. The VOC also revealed something a little darker that we'll explore in future episodes. That when shares become easily tradable, speculation emerges. Some investors stop caring about the company's fundamental business and focus entirely on predicting short-term price movements. This tension between investment and speculation has characterized stock markets ever since. Remember that tulip mania that we talked about a few weeks ago? Yeah, that is speculation run amok. Next week, we'll cross the North Sea to London, where Dutch innovations would be imported, adapted, and ultimately refined in the coffee houses that became the birthplace of modern stock exchanges. We'll discover how informal trading among merchants evolved into formal markets with rules, regulations, and professional traders. So, until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is the Saturday Morning Muse. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public good with your friends, your family, your colleagues, and maybe the neighbor down the street. The show was produced by Nicholas Temte, and we'll see you next time on the Saturday Morning Muse.